Is Lucid Motors on track to become the first mainstream EV startup brand to go under over the next 12 months? This important question is on the minds of most investors and EV fanatics, as the company in the latest quarter reported rather dismal results. Long story short, Lucid delivered just around 1,800 vehicles in the third quarter of 2023, when analysts had expected them to be north of 2,100. This paired with the fact that Lucid just cut its production guidance for the full year 2023 to 8 to 8,500 vehicles is certainly weighing down on Wall Street's expectations of how profitable and sustainable Lucid's business model really can be. Now, as bad as these numbers seem on the surface, folks, there are some important reasons for why they are where they are. And the company can certainly make some important changes to rectify its current situation. Because believe it or not, folks, things need to be put into context. And a lot of the numbers that you see thrown out on social media, as well as earnings and press releases from various analysts that cut their price targets on Lucid Motors and other EVs, certainly do not. And that is exactly what we're going to try to dive into in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. First things first, folks, let's just address the numbers right out of the gate. Lucid stock has hit a new all-time low, dropping to a market cap just around $8.5 billion, which is certainly a far cry from the near $50 billion valuation the company had at its IPO with the Special Purpose Acquisition Company in 2021. And let's be honest, folks, this is the story for a lot of clean tech and EV startups that went public through this expedited route. Companies saw insane euphoria throughout 2021 as pandemic stimulus checks flooded retail investors' money into the markets, which skyrocketed valuations of nearly any company that mentioned anything happening with growth. That certainly turned into a nightmare as interest rates went up and as this tightening phase increased from the Federal Reserve, resulting in higher borrowing costs as well as reduced demand from consumers and the heightened expectations of growth that these companies had laid out. And well, now what we're seeing is the repercussion of that in the form of material revenue misses, with somebody like Lucid significantly off its target it had set out for 2023, having delivered just under 1,500 vehicles in the third quarter, missing basically every single analyst estimate. Now, if you guys have watched my videos in the past, you guys already know that this kind of delivery reduction is an industry-wide phenomenon for electric vehicle companies. However, for Lucid, these macroeconomic forces are not the only reasons why the company is not meeting its expectations. The second biggest reason for why Lucid is not performing as well is because they're simply in the wrong market at the wrong time. Yes, electric vehicles are an important trajectory for the auto industry, and startups like Lucid are going to have the best shot at capitalizing on this market. But because traditional OEMs also have the ability to transition to electric vehicles from internal combustion, competition for Lucid is particularly growing faster than really any other segment. The problem is that Lucid is selling in an extremely niche market segment with vehicle pricing north of $100,000 for most of the specs that it sells. And this high price tag translates into basic economics and basic reasons for why Lucid is having such a hard time turning a profit. Because high pricing means low volume, and low volume means low profit margins, which are especially important for a startup company who has to please its investors by turning profits early on. And by profits, I don't mean on the bottom line, I simply mean on a gross margin basis. And in the price bracket that Lucid is currently selling its vehicle in, this is simply not possible unless the demand is significantly outstripping the company's supply. Not to mention the fact that sedan sales are already on the decline, with SUVs and crossovers being the much more preferred method of transportation for most people in North America, and luxury obviously being at a premium, especially at a time of high inflation. I mean, at the end of the day, what kind of cars do you see on the road more? Do you see more Toyota RAV4s, Corollas, Honda Civics, or do you see more Audi A8s or Mercedes S-Classes? You simply don't see luxury vehicles in high volume on the road. And that is exactly what makes it such a difficult business unless you start launching new products that are cheaper for the consumer. And there is no better example of this than Porsche, which, for example, sold around 2,000 of their Porsche Taycan EVs in the third quarter, which seems to be in many cases the best expectation of unit volume in this kind of segment, as governed by essentially the best luxury performance car automaker on planet Earth. If Porsche is barely selling 2,000 units in a quarter, and Tesla is barely selling 7,000 of their Model S luxury high-performance vehicles in the same quarter, you can't really have any sort of better expectations for Lucid as a startup which has yet to establish a strong brand image and even achieve multi-generation vehicle platforms. The main issue I see with Lucid, which the company is certainly working to rectify on, is the fact that they've focused much more on high performance, cutting-edge technology, as well as efficiency, rather than launching new products for increasing their market share in different segments. On one hand, although this innovation creates great opportunity for a competitive advantage, it also creates lackluster returns for most investors, because obviously the company is going to be facing a lot more losses as well as production hurdles if they're focused on refining their product and establishing this new luxurious lifestyle centered around the human experience. And that just so happens to be the reason why the Lucid Air was in development in the form of prototypes for so many years and only just reached mass production in 2021. At the end of the day, the company was focused on perfecting the design, the experience, as well as the quality of the vehicle, which from independent party reviews has certainly turned out to be very well. But from an investment standpoint, that simply is not in the favor of most investors, and we're clearly starting to see the repercussions of that in the form of earnings performance. Now, as for answering the question whether Lucid will be here to stay for the next few years, I think most likely yes. Not only is the company launching a new product, which is an SUV, which is exactly what it needs right now, but the company is backed by some of the best investors on planet Earth, particularly from a state called Saudi Arabia. We're talking more than $5.5 billion in liquidity as of September 30th, 2023, with more potential investments coming from a fund that already owns more than 60% of the company. And although yes, the company certainly needs to make an effort to reduce its cash flow burn over the past few quarters, the company has still a relatively solid balance sheet, with current liabilities sitting at around $1 billion and current assets sitting well north of $5 billion. At the end of the day, what I'm much more concerned about is the trend in this gross margin number, as well as quarterly delivery growth on a unit sales volume. That metric, in my opinion, is exactly what's going to drive success for Lucid over anything else going into next year. As usual, folks, that is just my take on the situation. Let me know your thoughts down in the comments section below, and I'll catch you guys in the next one. Take care.